Good morning. Yesterday we have discussed how trend lines are drawn, how time frame analysis is done, and also we have seen how candlestick intensity is measured. And today we are going to have the ninth class, which is one of the most important classes of this course. And this is of using indicators and how indicators are used in order to uh, understand charts better. So today's topic will be indicators, and in indicators we will be seeing relative strength index, volume, moving averages, and moving average cross. So how we are going to use these three indicators mainly, and using these three indicators, what is the kind of a meaning that we can get out of a chart. This is what we are going to know about. And as you can remember, in the previous classes we have discussed that how a candlestick is formed, how multiple patterns will be formed, and how we can determine the longer patterns using trend lines. So today also indicators, most often indicators have been marketed very wrongly, because most often people think that indicators they will be using. I mean, we can use indicators in a trading, but in my perspective, indicators are just how do I say? Indicators are just showing the past data of a trade, and using just the past data of a trade, you can't predict what is going to happen in the future. So most often what happens is, depending on over dependency on indicators happen, and they do not see what comes in the future, and they lose the trade. They make losses. So indicators are a good tool, but they are mostly they are depending on the previous data, and just depending on the previous data we cannot take a trade. And that is the main disadvantage of indicators. They seem to be very apt, they seem to be very right, but at the end of the day they just are the uh, past data indicator. So we also call them as a uh, delayed indicators. I mean, delayed data, because this is of only the past data. We cannot predict the future using the indicators. That is the first disadvantage of indicators. But coming to indicators, what does they do? In a chart, if you see, what happens is, if you have to analyze a chart, we have to have total analysis of a chart. Let's just say we are talking about Tata Motors. Then we have to see 10 years of data, 10 years of candlesticks forming, and what are the lows, what are the highs, how much volume is coming into the market. We need to spend time on a chart in order to make analysis of a single stock. But what indicator does is, indicator does all this analysis by themselves and give us the final data. So by using indicators, what happens to our trading is, our analysis gets faster. We can analyze similar data on number of charts. So this is the main advantage of indicator. So first of all, we'll get to know what is an indicator. Let's just say we are going to when you are using Excel, Microsoft Excel. What we do is, in order to add 10 quantity, what we do is we just keep sigma over there, sigma, and we drag them, and the final output comes up. So indicators are the similar thing. When we are doing multiple calculations, when we have to analyze a big amount of data, then what indicators does is, it will be easing our effort in order to multiply, in order to plus, how we use sigma and all. Similar thing happens in the indicator also. So indicators does this simple job. It analyzes the chart, in a combination. It doesn't give any new data, it doesn't have any future forecast, it doesn't allow us to predict the global markets and everything. It just gives us the data which is there in a precise manner. This is what indicator does. This does not. So using that past data in a precise manner, we can predict the future again. We can predict the trade, where it will go. So that is our job to do. But indicator's job is to just give the data in a precise space. So give it in a combined manner, so that we can analyze many charts in a faster space. On a faster pace, we will be able to analyze data. This is the only advantage of indicators, but they do not predict any future. So coming up, first, we are going to discuss relative strength index. So as we have discussed in the previous classes, We know that there are two parties in the market. One is the supply side, one is the demand side. So in between these two, there is a tug of war in the market, and that is what displayed in the candlesticks. But what does a relative strength means? So relative strength index, this is what we call RSI. This is a most often tool that I use. And also relative strength means which side has more strength. This is what simply defined. Relative strength of either the supply side or the demand side. Relative strength of which side? Is it the supply side or is it the demand side? This is what the indicator does. Relative strength index. So RSI. So first of all, we'll see how RSI works on a live chart. So this is a 5-minute chart of a Bitcoin, and we see that there was a sell-off in the market again from the 106 level. We have reached somewhere around 105, and again market is in a supply mode. After this is a 5-minute chart. So here we can see that we applied an indicator here. This is called RSI 14 close. So what does RSI means? Relative strength index. What does 14 means? 14 means it is calculating 14 candles. It is considering it is taking into consideration 14 candles and making an index out of it, making a relative strength index out of it. That is what 14 means. So in order to elongate, we'll go to the 1-day chart. See, this is a 1-day chart, and in 1-day chart it is considering 14. Means 14 days candles it is considering, and it is showing the strength of 14 days, relative strength of which side is more. So that is what RSI means and 14 means. If we can change this RSI 14 also, we can make settings and we can change it. We can change the inputs. We can directly input 52 weeks, 52 days. So here right now it is showing 52 days of data, and that is what we have changed. Using settings and inputs, we have changed the RSI from 14 days to 52 days. So right now what it is projecting is, it is projecting 52 days of data, and that is what we can see here. So on a 52 day, we are seeing this data. That is what it is. And always RSI relative strength index comes in between 0 to 100. This is a scale that we see RSI in, and that comes from 0 to 100. But most of the times, at least 90% of the times, market does not go above 70 and below 30. Always market maintains a level between 30 to 70. This is a medium space in which market most of the time spends. So we can consider 30 and 70 are the indexes, which means 30 is in between 30 and 70 the market keeps flipping up. So this is what we understood. So what does 30 mean? What does 70 mean in market? So in order to understand relative strength, we have to understand that when a market is in a lower state, let's just say market is in 30 or below. So what does that mean? There is low amount of demand in the market, and that means that there was ample amount of supply in the market. So supply is dominating the market. Since we know that supply is from above and demand is from below, when demand is at, let's just say RSI is at 30, that means that there is low amount of demand and there is strong supply coming up into the market. This is what 30 means. Similarly, when the market is at 70, what we understand is there is strong amount of demand in the market. There was a strong amount of demand in the market. So most often how we use RSI is when strong demand comes into the market, after a while the market gets exhausted. After a while market gets exhausted and it takes a U-turn. So after demand reaches its peak, it will reach its exhaustion, and then supply side will take over. And so they will push the prices down. This is how RSI works. Similar thing happens when there is a ample amount of supply. After a while supply gets exhausted, and demand takes over. And when demand takes over, the price will push up. So this indicator is a meaning of this chart itself, but it will be much more precise, much more sharpened. So when we can understand that when market is getting exhausted, when supply side is getting exhausted or when demand side is getting exhausted. As we can see, market is right now on the top and the relative strength is on a medium level. So we assume when market is in these levels, let's just say market is right away is in 54.65, means market is not neither in a totally strong demand, market is neither on a totally strong supply side, market is in medium. So market can flip anyway depending on the price action, depending on the market conditions, economic conditions, these all matter, these all factors impact this market. So right away market is at 54.64. So what we can assume is it is on a downturn, but most probably we are assuming that depending on the market conditions, this might flip and go upwards towards the supply, towards the demand side might push, demand side might push the prices up. This is what we are assuming right away, that because market conditions are really good and the S&P global conditions are really good. So depending on these conditions, we are assuming that market though might have a slight downturn, it will again demand will gain back its momentum and it will reach new highs. This is what we are assuming for this month to come. This is our prediction. So depending on that, what we understood right now is, so RSI, relative strength between supply and demand. When demand reaches its peak, supply will take over and push the prices down. When it reaches its down point, see what happened here. When market reached this point, this means that market sold off significantly and the supply side is getting exhausted. So demand is taking over from the bottom of the market and demanding is pushing the price up. That is what we can see in the chart also. So one of the way to understand relative strength is, whenever supply is at its peak, then demand might see that okay, market got oversold. So we also have to understand two words. One is oversold, one is overbought. When demand is at its peak, we can assume that market was overbought. We understood from the previous class also that market always tries to maintain an equilibrium. Whenever market goes above or beyond equilibrium, it always tries to come to the equilibrium again. That is what is happening here. When market reaches its peak, it again tries to come to the equilibrium. When market reaches its low, it again tries to come to the equilibrium. So that means that whenever market is in a total supply side, when supply side is totally dominating the market, then we can say that market is oversold. That is how we see market is oversold. Everybody who is selling got exhausted. That is the meaning of market got oversold. Same thing happens when on the demand side also. When market reaches its peak on the demand side, we assume that market is overbought. There is nobody else who is demanding the stock. There is nobody else who is demanding the market to go up. So that means demand side got exhausted and now supply side might take over. That is what we see in the market. So RSI works in order to understand which strength lies in the market. Is it the demand side or is it the supply side? This will give the much more precise meaning of a chart. So this is what indicator does. Indicators, what does they do? They give us a more pronounced understanding of the market, of the charts, and they will give you very faster results. That is what indicators are used for, and that is what these things are used. So RSI is a very efficient tool. We can use it in a shorter time frames also. If we are doing any leverage trades or risky trades, then also we can use relative strength. Most probably market follows them that is what relative strength is. When we are doing shorter time frames, what happens is longer time frame trend will push down the market. For let's just say we are going right now, what we understood is market is taking a U-turn on a 1 hour chart and it is going up. This is what we have seen in the 1 hour chart. But when we go this same thing into the 5-minute chart, we see that in a 5-minute chart market is already topped up and it's trying to push down. So this 5-minute, when we are using RSI in a 5-minute space, we have to understand that the 5-minute RSI will only last till 10 to 15 minutes. RSI relative strength, when we are shortening its time frame, we understand that the relative strength is only applicable till 5 to 10 minutes, because we are seeing 5-minute RSI. then the valid trend of an RSI will only be exhibited into short term. It's like just say 5 to 10 minutes, maximum of 15 minutes. So we are taking, if we are taking a trade depending on the RSI, 5-minute RSI, then we have to be in a trade let's just for 10 to 15 minutes. There is no extension for it. That is how we see RSI. So RSI is a usable tool, but we have to understand the time frame that we are keeping the RSI also in. So if you are taking a trade for 2 days, then we have to shift our time frame towards 1 day, and we have to understand that on a daily time frame the market is trying to push down. That is what we have seen in the yesterday's session also, and today also it might be pushing down. But overall trend, as we know, overall trend, then again we'll go to the weekly chart. So this is a weekly chart. On a weekly chart, as you see, RSI already is in a 60.9, and again we assume that market is getting exhausted, but it is not exhausted so much. So we are expecting the market to go up and then get exhausted. Till then, we are expecting the price to reach 120 or 150K on a Bitcoin price we are talking about, and then it might take a U-turn. So this is what we are expecting on a longer time frame. But depending on the longer time frame, we are not going to do a shorter trade. If you have to do a shorter trade, then we have to consider a shorter time frame. That is what we have understood in a time frame analysis. We are coming back to 5-minute chart. See, this is what a 5-minute chart is indicating us, that market is coming downwards. When market totally gets exhausted, when RSI reaches bottom, then we can take a U-turn, or else market reaches the top, then we can take a U-turn from there. And that trade only is applicable till 10 to 15 minutes on a RSI scale, because we cannot assume, we cannot be in a trade for 1 hour taking a depending our analysis on a 5-minute chart or else a 5-minute RSI. This is a very important time frame analysis depending on the which trade we are going to take. So first we understood what is RSI and what are the ratios on which scale we measure RSIs, and depending on the market exhaustion, depending on the oversold and overbought conditions, how market flips over and goes in the opposite direction, always finding a good equilibrium in the market. So that is the overall understanding of relative strength index, which is a very useful tool in understanding the markets and analyzing the charts on a shorter, on a faster pace. So second indicator that we are going to consider is a volume. As you can see, we are in a daily time frame. On a daily time frame, these are the candles that we have got, and here on the downside we see that there is a volume bars. So these are also an indicator. So what do volume indicate in a market is, they indicate that when a candle is formed, how much volume is coming up in the market. So sometimes what happens is, there is just a plain manipulation in the market. They just push the price up so in order to make a candle, but in that candle there is sometimes very low volume. That means with very low volume, just manipulators in the market who are having, might be banks, might be investors, might be retailers also, they might be pushing the price up without any strong concrete backing of a market, without any strong backing of a volume. That means that it is a manipulated price. Then those kind of situations, in those kind of price action situations, we can check with the volume. When volume is coming into the market and the price is pushing up and a candle is formed, strong candle, that means that there is strong confidence in the market there is strong backbone of the market, which is volume, which is pushing the price up. That means that is the authentic candle that has happened. But sometimes what happens is, the candle is big enough but there is very small volume. That means it's a manipulated volume and it cannot be sustainable, because always if a price is moving up, it has to have a strong volume coming into the market. Volume is there is traders who are putting their money in buying that stock. That is what volume is. Volume means, let's just say somebody is purchasing bitcoins. That means somebody is putting their real capital into the market and purchasing this volume, and they are driving the price up. They are creating the demand. So that volume is creating the demand. That means it is a organic market movement. But sometimes manipulators, exchanges, traders, they push they manipulate the market, and in order to manipulate the market, they cannot increase their volume because their volume size will be low and the price will be more. That way we can catch either it's a manipulated market or it's a organic market that is going with the volume. So we'll see some conditions here. As we can see, this is a small candle. In order to see, there was slight price movement. Yes, the price came up, but there is strong, it made a small body in this candle. But at the same time, if you come down, there is ample amount of volume in this market. So when price has dropped here, people started buying. There is ample amount of, though these candles are large, their volume is very small. See, this candle is this big, but at the end of the day, the volume is very low. But this candle body is very small, but yet the volume is big. This means at this point of time, on this day, on this particular day, 2nd of June, there was ample amount of volume coming in the market, and this is the organic push in the market. That is what volume does to us. Volume will give us a more precise understanding of how volume is coming up and why prices are moving up. So there is a correlation between the price movement and the volume. When there is no correlation, let's just say prices are moving up this much, but there is very small amount of volume. Here we can see there is very low volume and the bar is at least a little bit longer. So there is very low volume, yet the prices, I mean, in an uptrend, we see that there is a selling volume and that selling volume is also very low. So when market makes a downturn here, we don't have to be assuming that market has flipped because the volume is very low. It might be just plain inactivity. A lot of traders are not ready to participate in the market on the day, or else some people are booking their profit. There might be many conditions, and this also indicates that there is no U-turn in the market. For let's just say in this candle, when market is making a U-turn, you see there is ample amount of volume coming into the market. So what this means is there is ample amount of people who are selling the market, who are booking their profit at these levels, and that is what is seen in these two candles because there is strong amount of volume coming up. Same thing also can be observed in these volume bars also. Though the body is very small, we see that there is strong volume coming into the market just yesterday. When price has reached this point of 103K, then there are a lot many people who are ready to purchase the market, and that is what we see strong volume coming into the market. We can also say after this candle that there might be a strong push into the market because there is ample amount of volume happened in this market. So volume, it also makes a clear understanding of a market that either this is an organic price movement or this was a artificial price movement or manipulated price movement. In order to catch these things, we have to practice more on the volume. I mean, taking these indicators, we have to use these indicators depending on the price action happening in the market, and then we can make a clear sense of how volume impacts these markets and how we can validate our price action, price movements, taking volume into consideration. So this is the second indicator which is very useful. We can make a lot of sense of this indicator. And the third indicator we are going to see is moving averages. So here we can see we have to find moving averages. Moving average, simple. So what does this do? This is a simple moving average. So first, a little background about moving averages. What does a moving average do? Average means when we are, for let's just say we'll take this example only. This is a simple moving average 9, and what does this do on a daily chart is there are on everyday basis the price was at 9 points on a scale. So what does simple moving average do is it will calculate, it will add all the 9 days of price and it will divide it by 9. So after doing that, they on a moving average scale, what happens is, if you are adding 9 days of price action, 9 days of prices and dividing it by 9, there comes a point which is a medium line between all these 9 days price. So let's just say these are 9 days of price action, and after these 9 days of price action, it will calculate the price and it will divide it by 9. Then this is the point that comes up. This is a medium line. So what market is moving average is doing, it is moving along with the averages. So all this, after every 9 days, it will create a point, it will create a point, it will create a point, and it will draw a line according to the point. So that is what is moving averages. So when we are considering 9 days, 9 days moving average, this is what 9-day moving average is. So if we have to change the settings, then we can change the inputs also. We can directly go to 52-day moving average. See, this was the 52-day moving average. What market is doing, every time the price comes to the 52-day moving average, people are buying up. Every day market is coming to 52 moving average, people are buying up, because they are taking 52 days of average as a base point. When market comes to that point, they are seeing that, market is, at a level where we can purchase a stock, then they are purchasing it. And when market is moving away from the market, when market is moving away from the moving averages, they are selling it, because it has to come to the moving average to take support again. So when market is over bought, they are selling it. Then they are, when market is oversold, they are purchasing it. So that is what is happening. So how moving averages work? They are an average of the input that we are going to take. This is a 52 days moving average, that simple moving average. There is no complication. It calculates 52 days of it adds all the prices on a 52 days and divided by 52, it makes a point and it draws a scale touching it. So this similar to here, it is calculating all the 52 days. This is calculating 52 days. This again calculating 52 days. The moving average increasing, and whenever market comes to the 52 days moving average, then they are traders are joining in and purchasing the market in order to push the price above. This is what is happening in the market. So this is very simple understanding of simple moving average, and we can change the inputs depending on our trading styles. So simple moving average is average of all the days inputs. 52 days moving average. Okay, right. So one more moving average that we are going to see here is, this is a EMA cross. So this is a EMA cross. Cross means what we are doing is, we are taking two simple moving averages. One simple moving average input is at 50 bars, 50 candles, and another simple moving average is at 200. So 200 days of activity is being calculated in the 200 day simple moving average, and 50 days of activity is calculated at the 50-day simple moving average. And these both are sometimes, in order to understand a market, these both are very important, because sometimes what market does is, this 50 moving average is very much attached to the price action happening in the market, but this 200 moving average is very stable. When market comes and market flips above this, then that means that we can exit the market. Similar thing we can see, there is a plus symbol here, which we call as a cross. So what happened is, this blue line is a 200 moving average, this red line is a 50 moving average. So when 50 moving average crosses this blue line, that means that there is strong amount of activity in the market. When strong amount of activity is in the market, this smaller time frame, smaller moving average will cross the larger moving average and makes a cross. This means that here we can enter the market, here we can make a long trade in the market. Similar thing happens when, you can see here, when smaller moving average is coming below the longer moving average, and there is making a cross. So that means that here we have to sell our price, sell our market. So what happens is, from here the price might come down a lot. So in order to be on a profit side, you have to sell this market. We have to sell our shares, we have to sell our bitcoins and everything, and then we have to wait for this kind of opportunity where the smaller will break the larger moving average, and here we can enter the market again. So how this can be used is, when there are many stocks in a economy. In Indian economy, let's just say there are 10,000 stocks. In order to know which stock is at what point, in order to understand when we have to sell a stock, when we have to purchase a stock, we can apply this EMA cross onto number of charts spontaneously. We'll see the same thing here. We are talking about Tata Motors stock. See, just by clicking the Tata Motors, when we have to exit the Tata Motors stock, it was at 912. This was at 912. At 912 price, though market was at 1200, we have to exit here because the smaller moving average has crossed the longer moving average. This is where we have to sell our market. Still, it has not made a cross. So when cross happens, a lot of traders will catch this, use this indicator, and they'll come into the market and they'll push the price up. This is what normally happens. So by using this indicator, what we are going to do is, we are going to make precise decisions when to exit the market, when to enter the market. See, the same thing happens on a downwards. So when price was at 400, there was a EMA cross happened, and from here on 400 to 1200, the price has shooten up. So that means that when market is going on upper side, then the smaller will be on the top of the larger one, and when market is going on to the downturn, here as market is going on a downturn, they made a cross, then we have to exit from here. Though it is this very simple plain understanding indicator. When it makes a cross, then we can enter the market. When it makes a cross again, we have to exit the market. By doing this simple thing, what we will know is, we will be entering at 400, we will be exiting at 900, still we will be on a profit of 500. Again, when it makes a cross again, we can enter it and we can exit in when it makes a cross again on a downturn, then we can exit the market. By doing this, we'll always be profitable trader. There is no complication. Yes, this takes a lot of time, because this EMA cross, it has been happened on March 23rd. March 23rd to November 24th. So the market took almost year and a half for this cross to make. So similarly, again the same thing happens when this market flips. When a cross happens, you can enter the market, and when it again goes upward and it turns, it might take a year or so, it might take 2 years also. Depending on your capital, you will be on a good profit, and then you can sell off your shares. So this is how EMA cross works. Moving averages work. EMA cross is a very efficient tool. Moving averages also. So whenever market comes to the moving averages on a long, not 5 minutes, 5 candles or so, but when you are taking 50 candles and making an average of it, whenever market, let's just say we are on a bull run, when market goes out of our range, goes out of the equilibrium, we should not enter the market. We always have to wait when the market again comes to the moving averages, and then we have to enter. Though in a bull market, we should not run behind a trade, run behind a stock. So this is how moving averages are worked, and the indicators, volume is working, RSI is working. These are the 3 most efficient indicators. There are 10,000 indicators in the market, which will only complicate our trading journey. But in order to have a strong path, just use 3 to 4 indicators which are more stable, which do not spontaneously change and give you call and buy sell signals. These 3 are very efficient according to me, and that is what I have explained in this today's class. So, thank you.